Hi, Lindsay. Okay, well, I have not heard the Zoom lady say that we are recording yet.
I did hear her say we're recording, so I think we're set.
Oh, great. Okay, good. Well, welcome everyone. Good afternoon. I am thrilled to welcome you all to today's CLE, Financial Planning for the Equestrian Enthusiast. This is perhaps one of the most important and relevant topics for anyone involved in equestrian pursuits, but particularly for professionals. I personally wish I had the benefit of Eden's knowledge years before buying a horse of my own and starting my career, but better late than never. Eden is a certified financial planner and NAPFA registered fee-only financial advisor based out of Atlanta, Georgia. She is also a lifelong horse owner and hunter jumper rider. So she speaks from experience when advising her equestrian clientele. We are thrilled to have Eden sharing her expertise with us today. Eden, take it away.
Thank you so much, Lindsay. And thank you, everybody. It is wonderful to be with you this afternoon and spend the next hour talking about financial planning for the equestrian. Let me go ahead and share my screen. Okay. All right. So before we get started, I just want to mention that it will be best to hold any questions until the end of our presentation this afternoon. I'll try to leave time for Q&A at the end, but I also will provide my contact information for any further discussion offline after the presentation. I want to start by sharing a little bit more about me, even though Lindsay provided an excellent introduction. Want to go a little bit further in depth about who I am before we get started on the content. So I am a licensed certified financial planner and partner at my practice, Fee Only Financial Planning. The firm was founded in 1981, although I have been a part of it for the last 6 years. I am a registered NAPFA financial advisor, and for anyone who's unaware of what that means, NAPFA is an organization that advocates for fee-only financial planners. Obviously, given the name of my practice, I do identify as a fee-only financial planner, and simply put, that means that I am paid strictly by my clients for my advice. I don't sell any insurance or investment products with a commission received. So that means that I'm able to operate at the highest fiduciary level available. And really it means that my interests are most aligned with my clients. Furthermore, I am pursuing a master's degree at Kansas State University currently. I'm in my 2nd year of their program for advanced financial planning and financial therapy, and I've really enjoyed continuing my education through their program. Now, we are all horse enthusiasts here, so I wanted to provide a little bit more information about my horse background. So I've been a rider for 22 years. I've owned horses for the last 16 years. I actually grew up on my family's farm in Southwest Virginia. If anyone here is familiar with Virginia Tech, go Hokies. I grew up in Roanoke, Virginia, which is about 45 minutes away from Virginia Tech's campus. Similar to here where we have UGA and Auburn's excellent veterinary care as resources as a horse owner. I really benefited from growing up with Virginia Tech in my backyard for caring for our horses. So I attended school at Bridgewater College, which is about 2 hours north of Roanoke, Virginia. It's a private liberal arts school, and obtained a business degree with an equine studies minor. From college, after I graduated, I actually moved up to New England and worked at SmartPack Equine for 2 years. I learned a ton about equine nutrition and health and really enjoyed my time at the company. Ultimately, I'm a Southern girl though, so I decided to move back down south and changed industries and now really enjoy working in the financial profession. I have been living in Atlanta for going on 5 years. Now I'm actually operating out of Greater Atlanta in Roswell, so about 30 minutes outside of the city, to be closer to the barn, of course. And I'm currently leasing a 6-year-old KWPN gelding. Horse people love sharing photos of their horses. So I've included a picture of him here. This is Higgins. And we enjoy competing in the pre-adult hunters. He's been a really fun challenge for me this year for our lease, working with a young one, bringing them along, but having a lot of fun in the process. So diving in, I want to start by taking a really high-level inventory of what financial planning is and how it relates to the equestrian industry. My role as a CFP is quite comprehensive, and out of respect for your time and attention span today, we'll really only be able to brush the surface of many of these topics. So my goal is to share with you the things that I focus on when financial planning for my equestrian clients. These are things that you can be aware of when helping your equestrian clients, and hopefully this will provide some value to your own personal financial planning journey as well. Since we all share a love of horses, and I like to use words and concepts that everybody can understand when talking about finances, it can be, sometimes it feels like an intentionally smoke and mirrors industry. So you'll find I definitely operate from the mentality of keep it simple and talking in terms that people can understand. So for that reason, I wanted to start by sharing this illustration that some of you may be familiar with. I really love comparing this German dressage training scale on the left-hand side for horse training in a traditional classical manner with the traditional financial planning pyramid that you may or may not be familiar with. My job is to see the big picture for my clients and account for how all of their financial moving parts interact with one another. From there, I make suggestions on how to improve and optimize so that clients can reach their goals. The way that I do this is very similar to how we maintain, manage, or train our horses most effectively, and it's to have a system. So simply put, systems work. Having a system is key to being successful with your finances. As another personal example, I actually grew up doing a lot of natural horsemanship because my first horse was a crazy red mare. And I implemented a lot of the strategies from the Pirelli natural horsemanship method, if anybody's familiar. Their whole system is built upon the concept of like 7 games, as they call it, things that you should be able to do with your horse to create leadership and partnership. But I think there's a lot of correlation with that even as well, because 3 of the 7 games are considered foundational. So desensitizing your horse to things that they might find scary, teaching them to move off of pressure from the aids and also from like rhythmic pressure too. So those 3 foundational games then build upon, more comprehensive and technical games from there in training. So if anybody here is a natural horsemanship person, that might resonate as well as a parallel as we start talking about financial planning. So we'll be referencing the financial planning pyramid throughout today's presentation, but I also want to provide a course map for what we're going to talk about. So I've organized our content into 4 categories. We're going to talk about funding, protecting, optimizing, and preparing your financial plan. As I said, these do directly correlate with this pyramid that we're talking about. And the basis of that is cash flow funding. So we will start there. First and foremost, it's important to have the right tools to assess your financial position. The best starting point that I recommend clients start with is preparing or updating their balance sheet. For anybody who's unaware, it's also called a statement of financial position. And it's basically a 1-page snapshot that accounts for all of your assets and liabilities on one single page summary. Not only are we capturing a lot of information sometimes in a 1-page summary, which in and of itself is very helpful, but this exercise also calculates your net worth, which is a really important indicator of your financial health and a great way to be able to assess, am I moving in the right direction, or do I maybe need to review and modify some of the financial decisions that I'm making? Outside of your balance sheet, another vital tool that I have my clients use and recommend for everybody is some form of a cash flow worksheet. Cash flow is the foundation of a successful financial plan. It is the bottom rung of our financial planning pyramid. This is because for most, our income is one of our largest assets, and it's typically where I see the most room for improvement, especially for horse people. Most often I see this sometimes neglected in the horse industry for amateurs and professionals alike, because we are very easy to spend money on our horses, right? Absent a plan though, and a conscious spending effort, those kind of decisions that we're making can really have a detrimental impact on your financial health. So to start, I always recommend doing a historical audit of your spending. So I say, what did you actually spend it over last year? But getting really honest with yourself and using tools like, your credit card or your checking account. They have tools such that break apart your expenses in various categories. So doing a historical review to get in touch with your spending. If you are an employee, I recommend auditing your gross income, which includes reviewing your pay stub for benefits that you may be enrolled in and that are being deducted from your direct deposit that you're either not aware of or no longer provide value to you. So if you're an employee, start there. From there, categorize your expenses into broad categories. So I've included kind of a rule of thumb breakdown on this slide that have like a starting point of where to kind of begin assessing where your spending is and if it suits, what your financial goals are. So break apart living expenses as a category. Typically, a rule of thumb should be 50% of your income is going towards maintaining your lifestyle. That includes mortgage or rent payments, insurance premiums, utilities. Now we are talking about horses, right? So that also includes your board, your insurance for your horse, farrier, those are kind of things that we think of as maintenance or utilities for our horses. So take an audit of this and account for what you're spending and how that correlates with the income that you're generating. Now you can see here from our kind of rules of thumb, 50% to living expenses, 20% to savings and investing. Now that goes from long-term retirement plan savings to short-term emergency funding, right? But a 20% of income rule is a great goal to have. And then 30% for spending. And that's, kind of all the extras that we think about. Vacations for our horses, clinics, show, travel fees, new tack, right? Things that fall outside of the spectrum of like maintaining a lifestyle that would be considered under living expenses. So use these rules of thumb to kind of evaluate, where do I stand? Having an objective percentage-based approach to your cash flow eliminates, it provides context around what kind of decisions you're making. For instance, if you take inventory and your living expenses are closer to 70% of your income, that's an indication that you're likely living outside of your means. So where can you go from there? What changes can you consider? Furthermore, I've included 2 additional helpful, again, rules of thumb to consider when you're evaluating where your money is going. Starting with housing costs. So it's common to calculate your housing cost as 28% of your pre-tax income. So what are you receiving on a monthly basis? And what is either your mortgage, which includes insurance, tax, the full amount of what your living expenses are, or rent payment if you are renting. And then taking inventory of your total debt payments as well. So if you do have a mortgage, with your mortgage and other combined debt payments, it should only be up to 36% of your take-home pay. If you don't have a mortgage, if you're renting or have another non-traditional living situation, limiting your debt to 10% of your gross income is a great kind of benchmark to try to hit. So some of these can kind of help, again, highlight areas that you may not be aware of, where you're either spending too much or perhaps living above your means, or maybe you realize that your money, your money isn't necessarily being spent, but you don't know where it's going, and to put that into like a really targeted saving or investment program in a proactive manner. Now from here, this isn't just a one-time static exercise, your balance sheet and your cash flow, right? This is a dynamic, these are dynamic tools that should be revisited on a periodic basis. So I typically recommend redoing your balance sheet every year. I myself do it January 1st of every year, start the year off knowing, where do I stand compared to last year, compared to 5 years ago? How are things trending? Do I need to make changes to what I'm doing in order to benefit my financial position? And your cash flow, depending upon what you find from your historical audit, maybe it's something that you need to revisit on a monthly basis to start. If you feel like you have a pretty good handle on your cash flow, then, maybe it's 2, 3, 4, 6 months. Every 6 months you do an audit and just make sure that what you're working towards aligns with your spending behavior. It's easier to revisit this on a periodic basis and make minor adjustments according to trends that are coming up, as opposed to, kind of letting the reins go and looking back a year later and seeing, well, where did my money go, right? Now, when we're talking about making modifications, it's also important to consider not only decreasing expenses. I feel like there's a huge emphasis on that when people talk about cash flow, but also increasing your income. Inflation is here. If you're an employee, now is a great time to position yourself for a raise. Create a proposal and create an opportunity for, a review with your boss. If you are in a position where you are making your own business decisions, adjusting your rates, your fee schedule, these are things that require, review on a regular basis as well. And specific for utilizing variable income, or specific for addressing variable income, I always recommend using sub-accounts too as an easy way to help manage cash flow. So for instance, tax estimates, I myself utilize this kind of schedule for paying my quarterly estimated taxes. I have a separate account that I set aside my taxes on a monthly basis, and I pull from that to make my quarterly estimates. You can do so with have a separate horse fund, an emergency fund for your horse, separate from your household or family emergency fund. Utilizing sub-accounts is an easy way for us to mentally bucket our money for our independent goals. Okay, so continuing with our cash flow conversation, as I said, a 20% saving and investing goal is an excellent benchmark to strive for. And depending on your age, a minimum of 10% of that should be going into your long-term savings or retirement fund. Now, the other 10% or even more, if you have stretch goals, can include emergency funding. Again, maybe having a separate emergency fund for your horse of whatever dollar figure feels comfortable. A few $1,000s set aside, 10,000, whatever that looks like, depending upon the number of your horses or what that liability looks like to you. And a regular emergency fund of 3 to 6 months of living expenses. Additionally, this can include short or midterm goals like specific, travel, shows, gifting, etc. And technology has done a lot of really wonderful things for the financial industry, but one of my favorites is really leveraging automation. So once you've determined what your savings goals are and what your investing goals are, automate it. I mean, don't make it a manual hurdle that you have to jump through every month to set aside cash savings or invest X amount of dollars, in your accounts. automate it, and really put technology to work to benefit you. That way it's kind of out of sight, out of mind. For specific savings goals, I also recommend using the sinking fund method. And if you're unfamiliar with what that means, it's a really easy way to quantify a savings goal for a specific purpose. So we think about for easy math, if you have a goal of saving $20,000 over the next 8 months, for instance, you'll want to save $2,500 per month. And you can have a separate sub account again for those short-term savings goals. Approaching your money in this manner will eliminate deficit spending, and debt reliance, which is a huge systemic problem in our society, and something that I've seen quite frequently in the equestrian industry as well. So kind of proactively planning, and again, looking at your income is something that can be modified. Your cash flow can be modified in 2 ways: increasing your income and reducing your expenses. Moving beyond cash flow, we're going to talk about our next section, which I call protecting. And this refers to risk management on that on the financial planning pyramid, but more commonly referred to as insurance coverage. So here I've broken up what we're going to talk about reviewing insurance into 3 categories: for yourself, your horse, and your stuff. The overall goal here and takeaway is it's important to buy a lot of comprehensive insurance for a low premium. So buy a lot of insurance for a little money. And the purpose of insurance is to insure against a tragedy that you cannot afford. So protecting yourself. These are bare minimum coverage recommendations that we'll review in more detail. The health insurance marketplace has changed a lot over the last 10 years. Premiums are expensive, especially for self-employed individuals, speaking from experience. And I want to specifically call out that high deductible health plans are a great alternative to this reality. This allows you to have catastrophic health insurance in place with a higher deductible in mind. So whether it's, $5,000, $6,000, $7,000 of a deductible that you have to hit before the insurance kicks in, it's imperative to still have that coverage in place, so that if something happens, especially as a rider, participating in a risky hobby, it's vital to have this in place. And I'm still surprised by how many horse professionals that I meet who do not have health insurance. I also, with that in mind, want to call out for horse professionals, if you don't have insurance available in another manner, USCF actually offers group policy benefits at a reduced rate. I think their rates are, 15, 20, 25% below what you would receive in the marketplace, depending upon your qualifications. So they offer medical, accident, short and long-term disability. I think they even offer dental and vision policies as well. So just keep that in mind if relevant, for your clients. Talking about disability insurance. So there's 2 types. There's short-term and long-term. Short-term is typically either offered as an employee benefit, or it also is state regulated. So possible that there's coverage for you there as well, depending on your location. But long-term is really what I want to spend some time talking about. So I always think disability insurance is such a weird way to refer to what this is actually providing you. It's income insurance. It's protecting your paycheck. So long-term can be offered through an employer as a benefit, but it also can be purchased as an individual policy, similar to life insurance. And this is particularly important for those with specialized skills, such as lawyers, doctors, dentists, financial professionals, people who have invested a lot in order to operate in a specialized industry. When reviewing disability insurance, you'll notice there's 2 types, and I mentioned it here: any occupation or own occupation. If you're considering buying a disability insurance policy, own occupation is 99% of the time the way to go. What this means is that if you are found to be disabled and incapable of performing your own job at this time, they will pay out a benefit. If it's an any occupation policy, that means that although you're operating at a high level as a lawyer now, if you're found to be qualified and able to physically work at a 7-Eleven, they won't pay you a benefit. So own occupation policies are more expensive as a premium, but it's well worth the investment. Again, we're insuring against the tragedy that we cannot afford. Jumping onto life insurance, there are a lot of financial products built around life insurance. And simply put, all I'll say about that is I recommend buying term insurance and investing the difference of the premium. This is most necessary if you have dependents referring to children, not horses, and or large amounts of debt with a small asset base that cannot compensate for the income if you were not here tomorrow. Again, we're insuring against the tragedy that you cannot afford. So with life insurance, being aware that typically buying a term amount, buying a set amount for a term certain is going to benefit you, specifically if you have you're within a more risky window of having dependents or a significant amount of debt that we need to make sure is covered for in the event of a death. We're going to talk a little bit more about umbrella insurance on the insuring your stuff slide. So I'm going to hold tight on that right now. But also, I just wanted to point out for professional liability insurance is, the utmost important insurance that you can have, especially being in this industry, whether as an amateur or a professional. If you are a professional, though, I recommend considering an LLC, depending upon the type of business that you're operating in. But also, too, again, depending upon the avenue of horse industry that you're working in, having commercial general liability coverage and professional liability coverage is important. All right, let's talk about protecting your horse. I am a big advocate for equine insurance. Unfortunately, I have had personal experience making a claim on my major medical policy, thankfully not a mortality policy, but it is something that if you are investing a significant amount of money in a horse, it is worth insuring them for at least a portion of these types of insurances coverages available in order to make sure that you're protecting that investment. So I just want to quickly define the different types of horse insurance, equine insurance available. Major medical, again, it's comparable to human health insurance. So typically there's a bank of funds, X thousands of dollars that you can access per horse per year. And it is available to you in a policy for that specific horse. It can depend upon, pre-existing conditions, very similar to, again, health insurance for people. But there's also sometimes like maximum exclusions for various therapies, et cetera. This is what I've had personal experience claiming for. And I had a thoroughbred earlier this year who had to go to UGA for kissing spine surgery. And I was just honestly delighted. That's a strong word to use for claiming on an insurance policy, I know, but it was a really easy process in order to obtain his eligibility for coverage and, to prove the eligibility of benefits and then to receive the benefit in return. So what would have otherwise been a $4,000 medical endeavor ended up costing me just a few $100s. Similar to health insurance, most major medical policies have like a copay system in place. So whether it's, there's a deductible that you pay up to, and then they cover 80% of the health-related expenses over that amount, and you pay the other 20%. Some system like that is what's typical for these policies, although it can depend. Mortality is similar to life insurance. So you insure your horse for X amount of dollars, typically based on the purchase price and show records, training fees. And if the horse were to pass away in an accident, the insurance company would provide you with that amount of money. And loss of use. This is not as common as major medical or mortality. It's appropriate for competition horses or for a breeding operation, where and it's kind of similar to that disability insurance coverage, right? So where if a horse can't complete the function at which they are bred for, trained for, serviced for, if something happens where they can no longer do that, then you receive compensation for X amount of dollars from the insurance company. Okay, and finally, protecting your stuff. So I want to spend a little bit of time talking about this because these all should coordinate together and ideally be under an umbrella liability policy, which is what I referenced earlier. So your vehicle, homeowners, renters, farm, property, if you have a horse trailer, all of your stuff should have its own policy and have adequate liability limits on those policies. Now, specifically, auto insurance coverage is state mandated. And typically when you call to receive a quote for auto insurance, if you buy a new car, the default limits of coverage are what is set at the state level to be a state minimum. Georgia's state minimum is for bodily injury liability, $25,000 per person and $50,000 per incident. Property damage is $25,000 per incident. Now, again, if we're considering a tragedy that we're insuring against a tragedy that you cannot afford, only having $25,000 for a multi-car backup, or you hit a building and there's a lot of reconstruction that has to be done, it's not going to go very far. So this is somewhere that I see a lot of new clients come in with their insurance declarations of coverage, and they're wildly inadequate considering the high asset base that they have. So it's important to have adequate liability coverage on all of these underlying policies. And then if you think of it as an illustration of an umbrella is a personal liability policy that sits on top of and coordinates with all of those underlying stuff policies, okay? What's great about umbrella coverage, it's a lot of bang for your buck. So it's sold in increments of $1 million, and it would cost somewhere around plus or minus $150 in premium per year. So an annual premium per $1 million. If you think about that, that is a lot of coverage for a pretty modest amount of money. So this, making sure that all of your policies for your land, your fixed assets, your vehicles, your trailer, everything that kind of falls within all of the purview that you own, and then putting an umbrella policy on top of that is the best way to make sure that you have full liability coverage. All right, moving on to what I'm calling optimizing, which is kind of leveling up to the 201 level of financial planning now that we have like a really strong base established with cash flow, savings, risk management. And now we're going to talk about investing and tax planning. As a registered advisor, I have to be very conscious about giving specific investment advice. So we're going to talk about general concepts and suggestions. In the same way, it's important to note I'm not a tax professional. So these are two general recommendations of circumstances specific to the equine industry that I have encountered. So starting with investing, the key takeaway that I am going to say before we dive in is your life, especially life with horses, is exciting enough. Your investment portfolio should mostly be boring. We don't need to look for excitement in the investment portfolio. Looking further into what this means. So Diversification is a concept that's often talked about in terms of investment accounts, whether that be like multiple types of accounts or held across various institutions or custodians. But I would encourage you to think more broadly, specifically about these three listed here. Diversifying your income. So having multiple sources of income, whether that be you have a primary job and a side hustle, whether that be that you have various revenue streams from your existing service model, but in varying capacity, different fee schedules. Diversifying your income is a huge opportunity for review in your financial plan. In a similar way, diversifying your assets. So this means having different tax types, tax deferred, not tax deferred, across industries, which we're going to talk about in a moment in, investing in the market. And finally, diversifying the types of liabilities that you have. So for instance, if you are a real estate investor and hold primarily mortgage debt, diversifying away from that. Doing this and implementing diversification across your life ultimately helps to mitigate risk and volatility, which decreases your chance of losses and increases your long-term investment success. Right? So I would encourage you to do an audit of your life. How much of your financial position is concentrated in one company, in your business, in your firm, in real estate holdings, right? If you look at it, again, we're taking kind of a 30,000 foot view. What does that look like for you in your financial position? Asset allocation is a helpful tool to assess diversification. So if you consider like a pie chart of how your assets are classified, I like to say limit 5 to 10% max of your portfolio to speculative or alternative investments. Again, your life is exciting. Your portfolio does not need to be. The rest of your portfolio should be stocks, bonds, and cash, maybe real estate if you're, interested in investing in real estate. And set targets for each segment, depending upon how comfortable you are with risk. Typically equities, maybe real estate, are considered to be more risky, whereas bonds and cash, fixed income instruments, are considered to be more stable and asset preserving. So depending upon your comfortability, create a target and review that target a few times a year and reinvest according to what that target suggests. So whatever segments are low, you buy into. This concept of asset allocation is key in avoiding emotional decision-making, which money is emotional. So money is emotional. And so investment decisions can quickly become emotional, but using an objective model to follow eliminates that and removes, any kind of in the moment decision making that can be harmful to your financial position. This is a very timely conversation to have right now, considering the economic conditions. Finally, most elements of the market are outside of our control as investors. The biggest factor that is within your control is the cost of your investments. So I typically use in my practice index fund ETFs. Index funds are baskets of stocks and or bonds, depending upon what kind of fund that you buy. It is a bundled basket that is traded on the exchange as a stock. So there's more control over the tax liability as opposed to a mutual fund, and the execution cost at which you purchase or sell. The benefit of using index funds, typically these strictly follow the index in a passive invested manner. So these typically you can buy them for a fraction of what another actively managed fund might cost you. For example, you can buy an index fund ETF that costs a nickel on the dollar, as opposed to one that costs 50 cents or 60 cents, 70 cents on the dollar to own. So this is an excellent example of the lower cost the investment products that you use, the more of your invested dollars are going directly into the market and not in the pocket of a manager for that fund. And there's plenty of research that suggests that passive investing beats actively managed funds over the long term. And finally, again, in investments, automation is your friend. It is one of the best things technology has brought our industry. Once you have a plan in place, automate your investing purchases on a regular schedule. All right. So we're going to talk about optimizing tax planning in two facets. First, we're starting with talking about personal tax planning. I came across this meme on the internet, and I thought right about now, we could probably use a little bit of a laugh because sometimes financial planning can be a little dry, but I'm a big fan of Titanic as well. So when I saw this, I couldn't resist. I had to plug this in here. Unfortunately, unlike this meme suggests, dependency credits don't exist for horses as much as I wish that they did. High income earners often don't get the benefit of many available tax deductions or credits that other individuals might. So I wanted to specifically highlight two tax deductions that aren't subject to phase out and that I encourage you to take advantage of, which is retirement plan contributions, and if eligible with a high deductible qualified health plan, HSA or health savings account contributions. Both of these are limited to an annual max on a calendar annual basis, but these are worth highlighting that these are some that are not subject to phase out with the IRS rules. Again, also speaking to specifically equestrian circumstances, I wanted to highlight, if you choose to donate your horse to a collegiate program or a therapeutic riding center, if you choose to do that, you can deduct the value of the horse as an itemized charitable deduction on your tax return for the year of deduction. I do want to note that the value of a horse over $5,000 requires an appraisal. And my comment is always to get two appraisals. That way you have appropriate documentation if the IRS were to ask for it, especially if the value of your horse is quite significant. And finally, again, as I mentioned before, it's important to work with a tax professional as your personal circumstances require. Now, from a professional capacity, this is relevant if you have a horse business. So specifically, I want to call out the safe harbor profit rule, also called the hobby loss rule. So it reads that profit must be demonstrated for 3 out of 5 consecutive tax years if you are operating an equestrian, any kind of business, but specific to what we're discussing today, an equestrian business. I do want to note this is different for thoroughbred racing, which then goes to my point of work with a tax professional to understand those rules and regulations. But if you are operating as a business, track your expenses. It seems obvious, but I work with several small business owners that originally didn't understand the dollar for dollar value of, for instance, tracking your mileage. I work with an individual who has a side business doing equine chiropractic, and she travels across her state working for her clients and racks up a significant amount of miles doing so. The mileage deduction did increase this year to 62.5 cents on the dollar. So that directly offsets your business income, which reduces your taxable income at the end of the day. So tracking your mileage, there are apps like Mileage IQ that I personally use for conducting my business, and other qualified business costs as they come up. Cannot stress enough, track your expenses. Also important to note that breeding, racing, and showing horses can be depreciable, which again goes to my point, work with a tax professional. All right, our final 4 out of 4 topic this afternoon is titled Preparing, and what that references is estate planning. And this is a very important piece to consider, especially when we're planning for horses, and one that I imagine everybody on this call is maybe more familiar with than other individuals might be, given your study. But simply put, assets pass one of two ways: by contract or by your will. Contract refers to how the asset is titled in some capacity. So examples are if an asset is held jointly with rights of survivorship with another individual. If it's a beneficiary account, like an IRA, 401k, HSAs, people sometimes aren't aware that those have named beneficiaries, and other accounts that are labeled as transfer on death or payable upon death, TOD or POD. This also can refer to a trust account that is controlled by the trust document. And then everything else flows to the will and passes to beneficiaries as named in the will. Those assets are subject to probate, and without a will, intestate laws apply. Now, I wanted to specifically call out our Georgia intestate laws because I think it's important for your clients to be aware of what these say, to make sure that if they want something different, that they're prioritizing putting estate planning documents in place to account for how their stuff passes, right? So specifically, I want to call out if you have a spouse and dependents or descendants, they will equally share your probate property, and your spouse's share may not be less than 1/3%. So that can be quite large, though, if you consider that a spouse isn't receiving everything in order to then be able to provide for the dependent. And that could potentially be a lot going outright to children that might not be ready to receive it. And then finally, if you have parents and no spouse or children, so no descendants or spouse, but you have parents that are still alive, your parents will inherit everything. So if you have siblings that you want to account for, or extended family, nieces and nephews, the intestate laws read such that they would not receive everything by default. So again, it's important to be aware of how these laws impact your financial plan, and specific with horses, right? So my feedback is always as simple as it sounds: confirm the title of your assets first and foremost. A couple of years ago, onboarded a new client who actually in our process, we realized that his ex-wife was still listed as the beneficiary of his 401k. It was an old 401k account he hadn't thought to update. In the process of handling and rolling over, saw his name listed as the 100% primary beneficiary. So as simple as it sounds, I see it time and time again where these are out of date and not updated according to life events that make it necessary. So life, death, or like a relationship transition is typically what I consider a qualifying event. So if somebody new is born in the family you want to account for, a child, a grandchild, if somebody passes away, a spouse, a parent, a sibling, or if there is a marriage or a divorce, a change in relationship title, those are qualifying events you want to think through. Who's listed? Not just in my will, people think about their will, but the assets that are controlled by contract by these named beneficiaries. And specific to horses again, right? So it's an important starting point to evaluate what your goal is. If you're not here, what are you trying to provide for your horse? Whether that be, is it important for you to continue your horse's training and showing? Do you have an older horse perhaps that you're just trying to provide life care for, that you feel obligated to want to provide that to? Do you have an organization in mind that you might want to coordinate a donation to, so that that your horse goes to benefit, a program close to your heart? Simply, do you, have a close friend or a trainer that you would feel, would be able to support your horse financially if you were to leave them as beneficiary of your horse, and they could support them financially? Or do you need to create a financial plan in order to set aside some lump sum or sum of assets to provide the income needed to take care of your horse? So First, as with financial planning in general, understand what your goal is when you're trying to plan for your horse in your estate plan. And then when possible, keep it simple. So again, is your designated beneficiary willing and financially able to care for your horse on their own? Just adopt it into their family and, benefit from riding it and caring for it, but also go with the financial obligations of that. Or instead, do you need to leave some money available for care? I was recently working with an individual who, she's a dressage rider who has a really close relationship with her trainer. They've been together for years, and she felt led to leave her dressage horse to her trainer, but also she wanted to set aside some money so that her trainer would be able to afford anything related to his care. And so what we decided upon, because of her really close relationship and other agreements made with her trainer, is just naming her as a partial beneficiary of a qualified account. So a retirement account, one of her IRAs, just setting aside a portion of that account as going directly to the beneficiary, and having an agreement in place that this money that would be received if something were to happen to me is to go for my horse's care. That's a really simple option available with little administrative cost involved. For more complex situations, though, of course, you can employ a pet trust, but again, big picture out of this is that nobody likes thinking about death. Not nobody, but many people don't think about these things or check up on how things are titled until it's too late. And I've even seen complex trusts that have been created to, provide for XYZ benefit, but it's never funded. And so then that document is, it's void and inoperable. So making sure that you're, creating a plan that is coordinated, and keeping it simple at the root of that problem. That way it's easy to be flexible and make adjustments as you go forward. And with that, we have reached the end of our overview, and I can accept some questions. I went just a few minutes over, but we should have a few minutes to go over questions if they've come up.
Hey, Eden, I think you have some questions in the chat box. I'm not sure if you can see it.
Okay, perfect. Let's see.
If not, I can read them to you.
Let's see. Okay, no, I do. I see them. Thank you for pointing that out, Lindsay. Robert wrote, can you recommend a major medical insurer for horses? So yes, typical, again, similar to like health insurance, there's agencies that represent insurance providers. I do work with a local agency, local to Atlanta, greater Atlanta area, who represent several providers, but they primarily work with Great American Equine Insurance. So that is the insurance provider. And the agency, there's several agencies, but one that I've personally worked with in this area is the Harbin Agency. They do farm, horse, they cater to the equestrian community in this area. But Great American is the name of the insurer. And then Lindsay asked, in terms of preparing the inventory and spreadsheets you mentioned in the beginning, is that something you help your clients with, or do they prepare that on their own and bring the information to you? Great question. So I do build those out with clients during our engagement. That's like the first thing that we do is, take inventory of all of our resources and put them in a format that is easy to track and easy to understand. A lot of people, again, come to me having things spread out in so many different places or titled in different ways and are really unaware of the things that they have with their name on them. So a lot of what we do in the beginning is taking inventory of all of that, and then coordinating the most efficient way to connect those resources to their goals. I do have a balance sheet template and a cash flow worksheet that I'm happy to send as a template for anybody interested after our call too. Those are resources that I can provide if you prefer to do it on your own.
Okay, I don't see any additional questions. So with that, I think we can conclude. Thank you so much, Eden. We really appreciate your time and expertise. And maybe looks like Patricia would love to get the template, so maybe we can figure out a way to coordinate through your email, which is on the screen, and get those sent to her.
Yes, absolutely. Patricia, I'm going to put my email in the chat so it's easy for you to copy and paste. If you want to just send me an email and ask for those templates, I'm happy to provide them for you.
All right. Thank you, Eden.
Okay.
Thank you all for joining.
Thank you guys very much for having me. And I hope that you walk away with some information and that I haven't totally overwhelmed you. Have a great rest of your day. And I have included my contact information. I'll put my phone number in the chat too. That is my direct line. If anybody has any follow-up questions or wants to continue the conversation offline, please feel free to reach out. I'd love to talk.
Ladies and gentlemen, this does conclude today's meeting. Thank you for joining. Have a great afternoon.